Chapter 5, Traders Dynamic Index, the TDI. Let me give you an overview of the entire TDI before we break it apart piece by piece, and then I'm going to jump right into it and show you how we use it every single day, because this is the number one most important indicator on my screen every single morning. This is how I build my watch lists, this is how I find my precise entries, and this is how I know when I should be getting out of a trade as well. So this is not a crutch, not anything like that, but this is the indicator that the S2 is based off of. The reason for that is because it's a combination of strong technical indicators. It's a combination of two moving averages and an RSI, a relative strength index. It shows us if it's overbought or oversold during that day, and that would qualify it on our checklist, you'll see in a few slides, if we should be trading it or not. This is also going to help us identify the direction that we're going to try to trade it if it fits other parameters for that day. So you're going to use the TDI a lot. This should be the first thing that you look at when analyzing a chart, not the candles. This is available on most trading platforms, and if it's not, you can build it by combining the RSI with two moving averages. The TDI is 100%, like I said, the most important indicator that we use. It created the S2 entry signal, and really, this is what separates us from everyone else. The TDI does not lie. That's our saying, and it's just kind of like a corny little thing that rhymes, but it's really true. The candles, I've seen them try to fake people out. They induce traders. Everyone knows how to read candle formations. Everyone has found those free PDFs online. But the TDI is what separates us from the rest. Before we jump into the components of the TDI and how I use it, I want you to understand what a good trade looks like and how I identify it from the jump. That way you can know where we're going by the end of this course. So it might not all make sense to you. It should not all make sense to you right now, if this is your first time watching the video. But by the end of the course, you're going to be able to identify trades just like this one. It all starts with the TDI. The TDI is very important to us. It determines if we should be buying or selling during this day. The first thing that we're looking at always is what zone is the TDI in. We have two zones with the TDI, and I'm going to explain this to you in a few slides. A buy zone and a sell zone. That's above or below a stationary 50 value. That stationary 50 value is labeled right here. So you can see right now that the TDI, which is our RSI and two moving averages, is below, is below that stationary 50 value. That would tell us that we're trying to take this short. The proper entry signal comes when you find the confirmations. It's confirmed by candle formations, like you see here. This is a 3-candle formation that I'm going to teach you how we identify. It's called a Rocky. It's also confirmed by the direction of the EMAs, which you can clearly see. You guys identified these at this point, you understand. These are all pointing down, so we're only trying to go short. And market structure builds great trades. So when you have all of these confirmations, the EMAs, the candle formations, the RSI in the right position on the TDI, and market structure, off key levels, yesterday's low, yesterday's high, all of these confirmations that I'm going to explain to you over the next couple slides, that's what builds a good trade. This was a huge trade for us. Very large trade that was identifiable, like I just showed you, starting with the TDI, confirmed by candle formations, off key levels, and off market structure. It's that simple. I'm not doing anything too complicated. I'm just confirming what it's telling me. And the reason we can confirm it so well and so accurately is because of this TDI. The TDI does not lie. When you see it on the TDI, you throw it up on the candles, and that's how you find your proper entries. Now, let's get into the TDI piece by piece. There's 3 key components to building a TDI. You have an RSI, which is the green line that you just saw. You have a market baseline, or a liquid 50, whichever you want to call it. That's the yellow line. And then you have a trend line, the red line that you just saw. The RSI is a momentum-based indicator. For us, if the RSI value is greater than 50, we're only looking to go long. And if the RSI value is less than 50, we're looking to go short. That's not too complicated, I hope. I hope you can follow me so far. If RSI is greater than 50, we're going long. And if RSI is less than 50, we're going short. The other powerful tool that the RSI can be used for is when you're accurately drawing reaction points on a chart, you can use the RSI to spot divergences and keep yourself out of bad trades, out of trap trades. So keep that in mind as we go forward. I'm going to teach you about divergence in a couple chapters. Just keep that in mind. The RSI is very important to spotting divergence. Write that down with a little star. But mainly, RSI greater than 50, we're going long. RSI less than 50, we go short. In all the trades that I'm going to show you, you're going to see the RSI is green. Here I removed the two moving averages and just left the RSI by itself for you to identify it cleanly. We're going to add the other lines in a second, but I wanted you to see this is an RSI. Any questions on this? Again, just shoot me a screenshot, but I feel like this is pretty straightforward. We're just going to piece it together. Next, we're going to talk about the market baseline, or the liquid 50. This is a moving average that reflects market sentiment and dictates overall trend. When we're looking at a chart and we're analyzing it every day, the first thing that I'm looking at is what zone is that liquid 50 in? Is it telling me that we should be going long, buying it, or should we be going short? Depending on what that liquid 50 tells me, I'll then decide if I'm going to look at the RSI and the candles. When the RSI value is greater than the liquid 50 value, and both of those values, meaning both the green and the yellow lines, are in the proper zone, we're looking for long opportunities. When the RSI value, however, is less than the liquid 50 value, and both of the lines, meaning the green and the yellow lines, are beneath the stationary 50, we're going to look for short opportunities. So you're starting to understand that that stationary 50, I'm going to explain that to you in a minute, but that stationary 50 value is going to dictate as well if we're buying or selling. So we want the RSI value greater than the liquid 50 value above the stationary 50 in that buy zone for long opportunities. And inversely, we want the RSI value less than the liquid 50 value, so both of those lines in the sell zone under that stationary 50 to look for short opportunities. When you put them both on a chart, you can see here's your liquid 50 yellow line moving around your RSI. When the RSI, like I told you, is above the liquid 50 in the buy zone, above this stationary 50, so like you have right here, this would be something that we would look for long opportunities. Okay? Start to see that. We're in the buy zone, RSI above yellow, green above yellow. In the buy zone, we look for longs. Now, that doesn't mean you just start hopping in and throwing buys in. It means that's step one of the confirmation. And by the time we put the whole checklist together, you'll understand how that works and how you identify, okay, good, that's piece 1 of 13. Let's see if we get all the other confirmations as well. Let's add in now the trend line, the final piece. This is just a simple lagging moving average of the RSI. The RSI value must be greater than the trend line in order to consider going long, which means the green line must be above or coming through that red line to go long. And inversely, the RSI must be less than the red line. The value must be less than the trend line's value in order to consider going short. So the RSI must be under the red line in order to consider going short. Now, it's not that simple. We have to add all the other parameters in. Again, I'm not trying to oversimplify it, but I want you to understand what it is piece by piece. So here you can see an example what happens when we add the trend line in. You can see, again, if we're just referencing this section of the chart, you have the RSI above that yellow line, so green above yellow, and above red now we understand means good to go for long opportunities. So this TDI right here, this little piece of it, would be an area where I would look for long opportunities. But everything else might not be. You have to understand how to read it piece by piece. So remember, RSI above liquid 50, above red trend line, so above yellow and above red, means we're looking for long opportunities. RSI below liquid 50 and below trend line, so below yellow and below red, like down here, we're looking for short opportunities. There are 3 key levels that go into the RSI that structure the entire TDI. The stationary 50, which is that stationary middle black line that I was showing you, we're going to also refer to that sometimes as reset. You also have overbought and oversold. So let's start there. Overbought is the 70 value on the RSI. If the RSI has hit that value or has gone higher, it is considered overbought for the day, and we're not going to go long on that pair at all the rest of the day. I don't care how high the RSI goes, we will not go long a pair that has already touched the 70 value or higher. Here's an example. You can see the RSI touched the 70 right here. Here's the 70 value, broke through and continued higher. You'll say, Austin, there's money there. And I say, yeah, there is, but not for us, not for the S2. So these are pairs that you take right off your watch list. You would take GBP USD right off your watch list. You would say, nope, I'm not going long anymore the rest of the day. I don't care how much money it is. I'm consistent to my rules. I'm consistent to the S2. I'm letting it go. It's overbought. Let's talk about oversold. If the RSI has hit a value of 30 or lower, that's considered oversold. And we're never going to go short a pair that has already touched oversold. So it's just the opposite of overbought. Instead of 70, we're going at 30. Here you can see RSI touched the 30, just touched it right there. See the 30 right here? It just touched the black line. Our green RSI just touched it, came back off it, and then decided it wanted to go straight through it. And a lot of people here would say, Austin, look at all this money. You got to be short here. You got to try to make this money. And I'll say, no, you don't. That's not the S2. That's not my money. That's somebody else's money, and good for them. Seriously. But in reality, that would break my rules, so I would never be involved in that. I'm only looking to trade S2s. One more time, you can see here, 70, 30, that's our overbought and our oversold values. Take a screenshot of this if you want. That way you can put this above your trading desk and see this every morning. You will not go long a pair that the RSI touches 70, and you will not go short a pair that the RSI touches 30. Let's talk about the stationary 50. This is used to identify trend and market direction for the day. When the RSI is near the 50, it's going to be considered reset or consolidation. So when the value of the green line is around 50, maybe 48, 52, 51, that tells us that we're in some type of a consolidation. And I bet you if you look at the candles, you'll see the EMAs are also coming together as well, signaling to us that the market has found some indecision, needs to consolidate on a higher time frame, and make a move from there. So that's something that we don't want to be involved in. I never want to trade anything that has something to do with reset, has anything to do with consolidation. You get trapped around, chopped around, end up over trading probably and losing a lot of money. It's ridiculous. You just don't need to be involved in that. Like I said, any pair going into reset is going to be choppy and it's going to hurt. So avoid trading when the RSI is too close to the stationary 50. We're going to go into a lot of detail of that in just a second. Putting everything together, you can see here, we have the overbought, we have the stationary 50, and we have oversold. Those are your three key levels. You throw the RSI in there, you throw the two moving averages in there, and that is the TDI as a whole. Now, the stationary 50 is very important. You probably have heard me mention the buy zone and sell zone by now. Above the stationary 50 value, but below that overbought value at 70, is the sweet spot for going longs. That's our buy zone. When the RSI, the green line, the liquid 50, the yellow line, and the trend line, the red line, are all in the buy zone, we're looking to go long. Hopefully it hasn't hit overbought yet on that day, and then I'm in really good shape, and I'm looking to find some type of a trend there to go long, to jump on the long bandwagon and ride it to the moon, or for my pips. We're going to talk about the take profit in a little bit. We'll get there. I don't want to get too fancy with you yet. These zones are going to dictate the direction that we trade for the day. So really quickly, you can see here, this entire RSI, liquid 50, and trend line, all of it right here. Yes, it hit overbought right here, but all of this is in the buy zone. All of this is going on in the buy zone. You can see the stationary 50 value here, you can see the 70 value here, and you can see how this is trading really nicely right in between, and there is nice, clean, upward trending movement as you get the RSI crossing through the moving averages. The RSI crossing through the moving averages is going to be the indicator for entries. As we develop this, you're going to see that. I want you to see here, this buy zone very, very clearly now identified with this green box. That's where we're looking to go long. Again, another example, RSI boxed off in green, TDI in the buy zone, everything looks clean. All you'd be looking for here is long opportunities. Once again, guys, read the TDI, not the candles. The EMAs here are bunched up. You'll say, Austin, wouldn't you call that reset? We're going to get into that. I'm going to explain reset really clearly. I'll say, yeah, on the EMAs, but the TDI does not lie. The TDI, in this example, is telling us that we're going to get long movement upward. What did you get? Movement upward. So by reading the TDI first and trusting the TDI, especially the liquid 50 and what zone it is in, you can normally be right on the direction for the day. Sometimes you'll get in early. I still do it. But you're very rarely wrong if you read the TDI just early. Ask anybody in our group, how many times do I say, rarely wrong, just early? It happens all the freaking time. Let's talk about the sell zone. I'm sure you understand now it's going to be between the stationary 50 value but above the 30 value. So the RSI, the liquid 50, and the trend line need to be in the sell zone for us to go short. We're then going to break that down even further here and look for those crosses. You want that RSI crossing through the moving averages to identify the entry signals. I'm going to go into a lot more detail soon. I'm just giving it to you big picture. I want you to understand what the sell zone looks like here. You see here, EMA is telling us what are we trying to do? Sell. Everything's pointing down. Sell. Where are we at with the TDI? Clean in the sell zone, didn't touch oversold for the day. So this would be something that we would look to go short in. We would be waiting for the S2 entry on the shorter time frames so we take no pain and we catch the breakout short. Quickly, another example. I don't want to beat a dead horse. You see the liquid 50 in the sell zone all day under the stationary 50, but above the 30. So we're looking for shorts. We're looking for RSI crossing, and then on the smaller time frames, the RSI crossing to find that precise entry. But I want you to understand that the sell zone and the buy zone are very important. You should never go against them. If the TDI is in the sell zone, do not go long. If you think it's going up, that's fine. Don't enter until the TDI gets in the buy zone. Just wait. I've seen it too many times. I've gotten in early too many times to just, it's like frustrating at this point for myself when I still do it because I know better. I know that by the time this trade breaks out, I'm going to see an S2 that I could have just waited for it to, and there was no reason to get in early. So trust these zones, wait for the S2 entry, and that's how you're going to enter pain-free. I want to give you an example here of the TDI, all the levels, the candles, the whole thing on a chart. This is what my charts typically look like. We've now put the whole puzzle together, if you will. The only thing that we're not doing is looking at all three time frames at once, and that's just not necessary for us yet. We're going to get there when we get into the chart markups, but right now, I just want you to see the candles as clearly as possible. You can see the RSI labeled in green, trend line labeled in red, and market baseline liquid 50 labeled with yellow. All of this is going to come together as we start to add in more parameters of the S2. I want you to quiz yourself here. Which zones do you think we're trading in? And did we hit overbought or oversold for this day? So we're looking right here. You can see these black dotted lines. These separate the days. So we're looking right here at this day. And I want you to just really quick pause the video or whatever you need to do. Think, did we hit overbought or oversold today? And what zone are we trading in? Then when you take a closer look at this, you can see that this definitely did not hit overbought at all. And it's clearly in the buy zone, above that stationary 50, but below the 70. So all we would be looking to do here is go long. We're waiting on the smaller time frames for the crosses to enter pain-free for the breakouts. I'm going to repeat myself a lot because, like I said, I want you to be robotic with it. I want it to just be an automatic process. It's S2s or nothing. Again here, which zone are we trading in, and did we hit overbought or oversold today? Well, no, we definitely didn't hit overbought or oversold. We can see the lines. Definitely didn't touch them yet. But what zone are we trading in, guys? Think about it. You're in the sell zone a little bit here, comes into reset right here, and then back into the sell zone. So, would this be something that we would look to trade? Probably not. We like to avoid things that are coming into reset. Now, it also depends on the time of day that you're trading. But for us, typically, we're looking 5 to 11. We're looking in this New York time frame, and you can see when you have a pair coming into reset, it's typically harder to trade. Look at the EMAs. They're very flat and tight together. So even though we're in the sell zone to start the day, this is not the cleanest trending TDI that you're going to see. I'm going to give you a lot of examples of trending versus non-trending, clean versus dirty TDIs, we call them. They're just, again, stupid little nicknames that we give them. But what it really means is good-looking TDIs, like, yeah, this is trending and I want to be involved, versus a dirty one is something that it's like, maybe it's not the best one, but I want to trade today and it's worth the risk. You know what I mean? We're not going to really try to take those too often. We want to take those clean S2s only. Again, here, another one where you have the liquid 50 in the sell zone to start the day during Asia, and it moves up into the buy zone through the stationary 50. So this is another pair, another example where we would not be trading, because when you have this liquid 50 crossing into the zones from sell zone into buy zone, it shows indecision in the market, especially on a shorter term time frame like a 15-minute chart. It means that this day at least, you're probably not going to get a significant move in one direction. It's going to chop around and do a lot of different things. And that's exactly what this did. You can see it came up, came down, like it was all over the place today. And that's because it was in reset. We consider this reset, meaning the EMAs you can see are coming down from the day before. So we were in a downtrending market, but the liquid 50 and the TDI was moving higher. So you had disagreement between your EMAs and your TDI. And when they disagree, we avoid trading because that's reset. Just stay out. You can find a trending trade. There's so many currency pairs to trade, you don't need to be involved in this choppy crap. So let's quickly summarize the TDI before we move into the next chapter. The liquid 50 is the first thing that we're going to look at always, because the TDI does not lie. We want to see the liquid 50, the RSI, and the trend line in the same zone all day. We don't want to see the RSI having touched overbought or oversold if we're trying to trade that direction. And we only want to go long when the TDI is in the buy zone, and we are only going to go short when the TDI is in the sell zone. And you guys have already made a promise to me by watching this course that you're going to stay out when the TDI is near the 50 value, near that stationary 50. We know that that's reset. We know we're going to get chopped up, and we know that we're going to find better trades than that. We're going to find the trending trades. And that's another positive benefit of being a part of our team, is that the live room really helps to identify which pairs are trending from very early in the morning. So you know which pairs we should be looking at for that day versus which pairs are in reset and in consolidation. A lot of the times, the reset and consolidation is because of some news event that either happened earlier or is coming. And we can avoid that also by just doing up some basic research online and avoiding those news events. So stay out of reset, long when the TDI is in the buy zone, short when the TDI is in the sell zone, and we want to see the liquid 50, RSI, and trend line all in the same zone all day. Now, we're going to move deeper with the TDI, combine it with the EMAs and the candlesticks, and we're going to really wrap our minds around how to define trend, because we want to be involved in trending trades only, not counter trend trades, not reset or consolidation trades. And the only way to do that is to accurately combine everything I just explained to you with the TDI plus everything with the EMAs into one chart. Let's get into it.